Hey there, welcome back to VitalCash. Today we've got a topic that's crucial for anyone looking to secure their financial future: assets versus liabilities and how to generate assets. Understanding the difference between assets and liabilities is fundamental to financial literacy. It's the cornerstone of building wealth and achieving financial independence. So, stick around because by the end of this video, you'll have a solid grasp of these concepts and some actionable tips on how to generate assets. Let's start with the basics. What are assets and what are liabilities? Assets are things that put money in your pocket. They appreciate or generate income over time. Think of real estate, stocks, bonds, and even a well-established business. These are assets because they grow your wealth or provide passive income. On the flip side, liabilities are things that take money out of your pocket. They're obligations you need to meet, like loans, mortgages, or credit card debt. These drain your resources and are a hindrance to building wealth. Tangible assets versus intangible assets. There are two types of asset categories: tangible and intangible. Tangible assets are physical items owned by a company, such as a building, land, or computer equipment. Tangible assets are the main type of asset that companies use to produce their products and services. Intangible assets don't physically exist, yet they have a monetary value because they represent potential revenue. A type of intangible asset is a copyright to a song. The record company that owns the copyright would get paid a royalty each time the song is played. Real versus financial assets. Financial assets are non-physical assets. One can quickly convert them into cash. A point to note is that such assets represent a claim on the underlying value of another asset. One unique feature of financial assets is that they carry some monetary value, monetary assets. But one can't realize that value unless it is exchanged for cash. So basically, these assets do not have any intrinsic value of their own. Real assets are generally the physical assets that help a company to generate revenue. They carry an intrinsic value of their own, unlike financial assets, and thus are important to a business. Their intrinsic value is because of their substance and properties. They are more popular with investors for several reasons: tax benefits, less correlation with equity, attractive return, and inflation protection. Is your house an asset or a liability? Now that you have a better understanding of assets and liabilities, is your house an asset? In most cases, the answer is no. Unfortunately, your primary residence is not really an asset. That's because you are living there and will be unable to realize any appreciation gains. The answer may change if you have a plan to sell your house within a set period of time, but when a property is your primary residence, the expenses of maintenance create a liability instead of an asset. In addition to the regular expenses associated with your home, it is important to consider the compounding interest over the life of your mortgage. The costs will add up quickly to cut into any profits you gain from a potential sale in the future. Is a car an asset or a liability? In accounting terms, your car is a depreciating asset. This means that your vehicle may have value right now and you could sell it. However, while you own the car, that value usually goes down over time. Driving your car a lot, its specific design, high repair costs, and even the model and manufacturer can all impact your vehicle's value. Typical wear and tear play a role too, as do the costs of maintenance, gas, and insurance. When these factors end up lowering your car's value, it becomes a depreciating asset. If you've taken out a car loan, car depreciation is something you may want to watch carefully, especially if you plan to sell your vehicle after a few years. Depreciation could leave you upside down on your loan, where what you owe is more than the car's value. Is knowledge an asset? Yes, knowledge is an asset which is fundamental to the efficient and effective delivery of public services. This principle emphasizes the importance of an organization recognizing that the seeking and sharing of knowledge leads to better outcomes, including increased collaboration, improved quality of evidence-based decisions and continuous improvement, enhanced speed of decision-making and provision of advice, reduced duplication of effort, and increased business resilience. How do you acquire stocks? To buy stocks, you'll typically need the assistance of a stockbroker since you cannot simply call up a stock exchange and ask to buy stocks directly. When you use a stockbroker, whether a human being or an online platform, you can choose the investment that you wish to buy or sell and how the trade should be handled. 2 ways to make money with stocks: capital gains, dividend income. Both capital gains and dividend income are sources of profit for shareholders and create potential tax liabilities for investors. Here's a look at the differences and what they mean in terms of investment and taxes paid. Capital is the initial sum invested, so a capital gain is a profit that occurs when an investment is sold for a higher price than the original purchase price. Investors do not make capital gains until they sell investments and take profits. Dividend income is paid out of the profits of a corporation to the stockholders. It is considered income for that tax year rather than a capital gain. However, the U.S. federal government taxes qualified dividends as capital gains instead of income. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe for more valuable content on personal finance, investing, and wealth-building strategies. And as always, if you have any questions or topics you'd like us to cover in future videos, please leave them in the comments below. Thanks for joining us today on VitalCash. Stay financially savvy, and we'll see you in the next video.